once you start to read about it, it's too late. And, and I think that's the thing, is that the Melbourne market at the moment is missing belief and sentiment. Once the media is always the last to jump on the bandwagon. So once you start reading about it, you've missed the boat, unfortunately.
You're listening to Property Investor Tales, stories from the front yard.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha and I'm the head of the advising team here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier and will inspire you along the way. My guest today is Stefanie Palazzolo, and we talk about the crazy opportunity in the Melbourne market, which happens to be one of the most undervalued and understocked nationally. So enjoy this conversation with Steph. Hey everyone, as you know, Tabitha here, part of the Property Investor Tales Stories from the Front Yard podcast. Now, today I have with me who I call my sister from another mister, Stefanie Palazzolo. She's had no choice at all in that title, so I hope you're okay with it. We run similar teams side by side. I work with the advising team, so the team that put together strategy for our clients, and Stefanie's team, who are known as the property consultants or the investment agents. They take that strategy that the advisors and coaches set and then match property to it, and also look after the clients. So very similar teams working in unison. And Steph joined the Positive Real Estate team it was 12 months ago yesterday, so we've had an anniversary, which is awesome. And Steph comes from a long career in real estate. She's worked with some of the really big names, Colliers, CBRE, and we wanted to talk today about the opportunity in the market, because sometimes sentiment gets in the way of opportunity. And Steph, I'll hand over to yourself. Tell us a little bit about what's going on in the Melbourne market and what you guys as investment agents are seeing on the ground.
Yeah, sure. So hi everyone, Stefanie here. It's been an interesting 6 years for Melbourne. I think everyone can probably relate to that. We're just getting over the COVID downturn, and in the last, I would say, probably 4 or 5 months, I've definitely noticed a change in the Melbourne market in terms of sentiment from a developer perspective. Developers are starting to get warmed up. They're starting to position their projects for launches this year. And there's definitely some good sort of green shoots popping out in the Melbourne market for what I believe a really healthy recovery for sort of 2026, 2027. So we're still in an opportunity phase in the Melbourne market because the sentiment and the belief hasn't yet passed down to the actual general public. So we're actually at this really crucial window that if you're ahead of the game as a property investor, you can be getting into the market now before everybody else catches on. So I think we're at a really crucial stage at the Melbourne market at the moment.
Awesome. And it's really interesting because, we always, and when we're learning to invest and we're investors, we always want to be ahead of the curve, but being ahead of the curve can sometimes look like a problem or uncertainty. And so at the moment in the Melbourne market, we've got all the fundamentals that make sense for a market to be in a growth cycle, right? We've got a lack of supply, we've got a rising population, we've got a healthy economy, we've got all of that kind of stuff happening. But then because Melbourne has had a tough time, the sentiment, so how people feel about the market, the uncertainty around interest rates, we've had all those increases. Now we've had that little cut, that little taste tester, and we'll talk about that with you in a moment. It gives Melbourne the wobbles, even though it's got all the fundamentals for a very strong market. And would I be correct in saying that at the moment, areas like Perth, like Brisbane, their median price is actually higher than the Melbourne median price, with half and sometimes less than half of the population and fundamentals.
That's right. Yeah,
Yeah.
and it baffles me that at the moment, depending on which stats you look at, but generally as a whole, Melbourne is about the fifth or sixth most expensive city now in Australia. Now, there's not that many cities in Australia, so let's call it we're one of the cheapest cities. And by 2030, we're going to be the largest city in Australia. So it's baffling that Melbourne is now
Makes
cheaper than places like Brisbane, Perth, Adelaide's catching up.
sense.
It's insane. So we're definitely an area of opportunity. And what I noticed in the last couple of weeks of being on the ground and getting out there and attending events and meeting developers is, when there's something good happening in the marketplace, when the government start to get on board with it and look at areas for opportunity for themselves as well. So
Oh, tell
what
me
I've
about
no-
mm,
yeah, so what we've noticed is Developments Victoria, who an entity out of the Victorian government, they're starting to really double down in their developments. The Victorian government set their housing statement a couple of years ago, it'll be about 18 months ago now, to aim for 80,000 new dwellings every year for the next 10 years, targeting 800,000 new dwellings in 10 years. Now, they are
wow.
miles behind that target, miles and miles behind that target. Again, lots of different stats show different things. At the moment, they're saying they're sitting around 50,000. And I would suspect that 50,000 is from dwellings that were already under construction, don't really even fall into that 10-year window. Like, really, they should be counted sort of 2 or 3 years ago. And
Mm.
so Developments Victoria are starting to free up a lot of government land and turn it into opportunity for build to sell.
Ah,
So we're starting to see some really cool like ex-CSIRO sites, ex-VicTrack sites,
ah,
ex-Crown land being turned into development opportunities for
ah,
residential
that's
dwellings. So
crazy.
that's a really good sign that if the government is doubling down on it, that's a really good sign for us as well.
Yeah.
Yeah, so there's definitely some green shoots happening there, which is exciting to see.
Oh no, that's awesome because I might get you to talk a little bit to for the uninitiated that aren't part of our education program because we spend a lot of time educating our clients on the economics of the market and understanding where opportunity is. So it's not going into things blind, it's going into things understanding your opportunity and the fundamentals behind it. So tell us a little bit about why developers haven't been developing and why we have a shortfall. Because we often hear that there's a national shortfall of properties, but then people say, oh, but there's all these apartments on the market and nothing's selling, or there's all this land, why aren't they developing? So what's been happening that's got in the way of supply?
Yeah, look, there's lots of different reasons, but if we can narrow it down to the most crucial, and this is not
Mm,
just relevant to Melbourne, it's basically the whole of the East Coast. It's the cost of construction, and it's
okay.
not just the cost of goods. So getting timber and materials. It's the cost of labour. So you'll notice in a lot of the eastern states, Melbourne, Sydney, Brisbane, the state and federal governments are spending a lot of money on infrastructure, billions
Yeah.
and billions of dollars on upgrading highways and upgrading rail networks. Now, upgrading infrastructure is great, but what that has meant is that a lot of the people, a lot of the labourers doing the work are now doing government jobs and not able to do private jobs. So it's taking a lot of people out of the workforce. Obviously, COVID had a big
Yeah.
had a big impact on the cost of goods and the cost of labour. So there's lots of different reasons as to why construction is so expensive. But
Mm,
the reality is now that for a developer, let's call it delivering, a build cost of say $10 million 5 years ago or 4 years ago, it's now costing them $15 million. It's gone up
right.
on average about 50%.
Right.
So the cost of construction is now so expensive, and it doesn't matter whether that's 20 apartments in the inner city or 20 apartments 50 kilometres out. In particular, apartments has gone up 50%. So that has had a huge impact on the supply.
Yeah.
And unfortunately, a lot of developers and builders have pulled out of the game. They haven't been able to be profitable. They haven't been able to offload their product, and they've had to either sell sites or liquidate or go into administration. So it's something that we're seeing all over the country at the moment.
Right. And so, and the cost of building, we're not only talking apartments, right? We're talking townhouses, we're talking house and land. So
Yeah,
anything that is essentially a new build has been impacted. That would be
absolutely.
correct. Yeah.
I guess the reason I'm emphasizing on apartments is
Mm,
apartments are now the most expensive product type in property to build. And it's
right.
for a couple of reasons, the cost of excavating a basement,
Yeah.
typically because it's a larger site, it needs to be unionized, so that costs more money as
Um,
well.
yeah.
Typically, apartments are built in suburbs closer to the city, so the land costs more money. So that's why I was talking about particularly in apartments. Yes,
Mm,
the cost of housing and townhouses has also gone up significantly. But if you're talking about an opportunity as an investor, the house and land product is definitely an opportunity that our team have
mm.
identified for our clients because yes, construction costs have gone up, but there's still some really good deals out there to be had.
Yeah. And it's crazy that, you can still get house and land. What would be the minimum price point that you would get quality house and land that you'd consider doing? What would be the minimum price point here in Melbourne compared to Brisbane, as an example?
Yeah, I would say from the high 500s,
Yeah,
in the some of the outer pockets of Melbourne, there's
yeah,
some really good house and land options
that's
throughout
awesome.
Melbourne. Yeah, I mean,
Yeah,
you can't see that in southeast Queensland. You're looking at a minimum of sort of 750 for a good house and land in Brisbane. So the
yeah, no, that's,
opportunity,
yeah.
yeah, yeah, is
It's
incredible in
it's
Melbourne.
crazy, and we have one particular opportunity at the moment that I won't go into detail on today because it is for our clients exclusively. But it's in a pocket where there's a beach location, and there's some really good upside for clients. And we did a similar thing for. Oh, it's going back quite a few years now. I think like 2016 or something, where there was another market similar in New South Wales, and we saw those house and land prices. I think people got in at those at around that sort of high fives, early sixes, which 10 years later are being valued at 1 to 1.3. And so making sure that you understand where the opportunity is really important. And then getting in and not letting fear and uncertainty get in the way of making quality investment decisions. And I know it's I know it's really easy to say that, but when you're dealing with a lot of zeros, equally you want to be careful. And I come back to those the key metrics of understanding what is driving a market before you go into it, and then understanding your own personal risk in anything, and then what is your plan to mitigate that risk. So if I do buy a house and land package in an area and there's a delay with the build, or it takes longer to rent because it's in a new estate and so there's a multitude of houses all being delivered, does that make it a bad investment, or is it just something that I know is one of the trade-offs of buying in a big development that I then need to have a backup plan for so I can manage my cash flow and not get too stressed out when there are inevitable challenges. Because when we invest, it's never ever, well, when we do anything with housing, whether you're investing, buy your own property, whatever, it's not always straightforward, and there can be challenges. And you and I, we've seen a lot of challenges for clients, right, where circumstances change. And if you don't have buffers, if you don't have your backup plan and your B, C, D plans, if you don't have your strategy and you don't understand why you'd invest in an area, then it makes investing a pretty scary ride. And that's what we do here at Positive Real Estate. We make sure that all of our clients understand from an education point of view what they're doing. They've got a strategy, they've got their A, B, C, D backup plans, and they have the 6-star team at their fingertips. So people like Steph and her team, we have the property management team, we have the accounting, we've got the tax, the financial planners, you name it. Everybody's there to provide support for the clients. Is there anything else? I know you recently went to an Oxford economics seminar.
Yes,
Do you want to tell us a little bit about A, what that is, and B, what you learned? Because that'd be really cool.
yeah. So Oxford Economics, they're an international. Well, I hope I'm giving them the right justice here. They're an international research and economist company. They
Yep.
have no other ulterior motives. So you'll notice sometimes you might get stats that are delivered from CBA or NAB. Look, at the end of the day, they're a bank. So they're going to produce stats and data that help them sell home loans. Not that they'll be incorrect stats, but they'll sway them to make them look the right way. So my first point would be always be careful that if you're quoting a stat, see who has actually produced it is the first thing.
Very nice.
So Oxford Economics are completely independent. They actually provide data to the Reserve Bank of Australia and help the Reserve Bank of Australia make decisions like lower our interest rates. So it was interesting. I was at this event and, you know, Positive Real Estate, we pay a lot of money to have access to all of this data. So our clients get the benefit of getting all of this access. Awesome. All of this information, and it was more of an international seminar about how the Trump administration is going to affect the Australian economy and so forth. But one thing I found really interesting was everyone in the room, all of the economists in the room, did not expect the Reserve Bank to lower rates in February. They all called it they think they called it way too soon, and they believed that they did it purely to increase sentiment, improve market belief, and, you know, have a bit of a good news story before the federal election.
Of course.
So it's not always about managing inflation. Sometimes it's political. But what was interesting is, although inflation has dropped to a more safer level between that sort of 2 and 3%, the main reason they said it's dropped is because inflation of goods has dropped. So, you know, post-COVID, now sort of shipping and all of that is back to normal. The cost of goods has really pulled down inflation, which is awesome. However, the inflation of services is still actually really high. And it kind of goes back to my point before about cost of construction. Now that the cost of goods for construction has sort of stabilised, you know, we don't expect a huge increase anytime soon in getting timber from a timber yard or stone from a stonemason, but the cost of labour is still really, really expensive. So I found that really interesting, and I think it's still a while yet, and it's probably a lot of the economists from the Oxford Economics believe it's going to be a few more months before we see another rate cut, because they think they went too soon on that one.
Right, and there was even talk that it might stretch out into 2026, is that correct, before we see another rate cut? Yeah.
I think it was interesting, Tab, you know, we had this live event last night and we got to be belly to belly with a lot of clients, and interest rates was one of the main topics that we were chatting about with a lot of the clients. And, you know, I was chatting to one gentleman and him and I were on the same page. It was interesting. People get so fixated on interest rates, but if any of you recall that when we were at the peak or the bottom of how low interest rates were a few years ago, properties were going for $300,000-$500,000 above reserve. I personally was looking for property at the time. I went to about 20 auctions. I'm so glad I didn't buy at that period, because I would have totally overcapitalized. And I actually ended up buying something just off the peak when interest rates did start to go up. So, you know, I think with anything when it comes to investing, you've got to be asking yourself, like, yes, it's expensive, but compared to what? Or what's the trade-off? Exactly as you were saying, Tab, you know, okay, interest rates are a bit higher than they were before, but they're still at a 100-year low. And at the cost of what? Well, what that means is there's some great buying opportunities in Melbourne, but, you know, nationally as well. So I think we've always got to ask ourselves, what's the trade-off? And one more thing I just wanted to add, Tab, with again, some of the conversations we were having with clients last night about their investing. You know, a lot of people say, oh, where's the best place to invest at the moment? Or where should I be doing this? And even some of our other 6-star panel were getting asked questions about financial planning and tax and self-managed super funds. And it sounds like a cop-out, but it's always dependent on the individual or the couple. And it's so, and even, you know, the individual, I was talking to a few husbands and wives and partners, and they weren't even on the same page. So, you know, getting on the same page as your partner or your significant other, having the same set of goals and working towards that goals together and working out how property or how investing fits in with your strategy, I think is really, that's the main point.
Yeah, and I think to expand on that just a smidge, one of the questions from the group last night, we had about 70 clients in a room. We were doing one of our first live events post-COVID, so it was really fabulous to get together with all our clients, and it was a live Q&A, so clients could ask the Six-Star team anything that was front of mind, and it was no holds barred. And like Steph said, there was a lot about interest rates and where would you invest, and should you buy in a trust structure or should you buy in your own name, should you buy your own home first, and understand that there are fundamental rules for investing and what is right, but then there's also what is important to you. And sometimes it can be incredibly important to you or you as a couple to upgrade your family home because you've got 30 more years in the market, you're planning to expand your family, and it's not just about investing and putting everything on hold for someday. And so we like to make sure that we tailor all of our strategies to what works for our customer. And particularly for young people, like Steph and I are a generation apart. And so what is right for me is probably going to be very different for what is right for Steph. So there's a big focus for me on super. For Steph, she's in her 30s. It's going to be, I'm sorry, I'm outing you there, Darcy.
That's okay.
I'm in my 50s. So it's not as prevalent for her that she has to get everything into a super. It's about acquisitions for Steph and long-term goals. And the PPR upgrade is a perfect strategy for somebody of Steph's generation. So always make sure that when you're talking to whoever it is, whether it's Positive Real Estate or your own team, be really clear on what you want to achieve. Ask questions. When I first started investing, I made the mistake of reading a lot of books and then deciding that I had to do it a certain way. So I'd go to my accountant and I'd say, I want a company trust structure, or I want this. I didn't go to my accountant and say, hey, this is what I want to achieve. What do you reckon the best structuring and plan is to do that? And consequently, I didn't always get the best structure for me because I wasn't asking quality questions. So be clear on what your outcome is, which I think was the point Steph was making. Make sure you're on the same page. It's hell to try and coach anyone that is a couple that has different ideas. I could wax lyrical on that for hours. But just be really clear on what it is you're trying to achieve, because then the team can help you and we can talk about what market's right for you. Steph, one of the things, before we wrap up, one of the things that I was talking to a client last night, and he said that when he got into the Melbourne market, he was surprised because he had a property that had actually gone a little bit backwards in its valuation, and he thought he was at the bottom of the market and he was expecting growth. But it's incredibly hard to time the bottom of the market, right? And it's like the top peak of the market. You can't time the peak of the market. And just because things are still maybe a little bit in that. So say we were on the property clock, we'd be looking at Melbourne at what, 5?
Yeah, 5 or 6 o'clock.
Yeah, 5 or 6, but you never know if it's quite 5 or 6, and it might be.
I feel like it's 6 because it's got some, I've seen some green shoots and I'm like, yeah, I feel like it's 6.
Awesome. And maybe if we were in the market 6 months ago, it might have been more towards 5, and it can go up and down a bit. Like, it doesn't have to follow a linear path. But when we're at that stage, sometimes it means, because think about, where do valuers get their data from? When they're doing a valuation, A, they're going to be conservative. B, they've got to get their data from somewhere, and they're looking backwards. So Steph and her team are projecting forward. They're looking for opportunity in the market moving forward, and they understand all the drivers that make us think that it's somewhere around 6 o'clock. But when you're buying at that time of the market, it is maximum opportunity, but your trade-off is that sometimes you get low vals because valuers are looking backwards at less favorable conditions. So Steph, what would your advice be to someone that's nervous about the market, understands that there's opportunity, but then gets the wobbles because they're worried about timing it poorly. What would you say to somebody?
Do you know, this is just my husband, basically.
Oh,
So I have this conversation all the time, and I try and bring it back to, well, what's our goal? I mean, we're not purchasing to flip it in a year. If that was your strategy, which it's not something that Positive does, but if that was your strategy, no, I wouldn't buy in the Melbourne market right now because it's not going to work for you unless you're a tradie and you've got access to, some awesome friends like we were talking about last night. No, I wouldn't recommend that. But is it to, to minimize your tax, or is it to be positive cash flow, or, what is your goal and how does that fit in? And I think if you can keep bringing it back to what's your goal to invest, what's the reason,
what's your
for
time?
me, at least, that works for me and for the conversations I'm having. Everyone's going to be different, and it's going to come to your risk appetite as well. There's going to be people who are willing to take slightly more risk, or who are in a position financially to be able to take more risks.
Yeah.
And if you're really not feeling right about it, it might not be the right property for you, or it might not be the right strategy for you.
That's very true.
Yeah, it might not be, or it might not be the right timing. But I would always bring it back to what's your goal for it. We like to say buy well, don't sell, or buy well, strategically sell. As we know, it takes the average property in Australia about 16 years to double in value. Now, our team go and try and find the best deals possible that have a really strong capital growth that hopefully can double in value in less than that. And so, if a year after you've purchased, you've still got a slightly lower val, if you're planning to hold it for 10 or 15 years, how does that even, it's irrelevant to your goal, really. So I would say always bring it back to what was your goal in investing in the first place.
Yeah. And what are the fundamentals? Like, you've just got to check that off. If you've got the fundamentals, you bought well, there's going to be these fluctuations in the market. Like the share market, it goes like this. Yes. And you have to be prepared to ride, a couple of corrections in amongst the general trend up. And I think, just to echo what Steph was saying, if you are nervous, like Melbourne has probably the most opportunity, would you say, Steph, in the Australian market at the moment? Yeah. Definitely. The most undervalued, the cheapest city for its size and its economy and all of that stuff that we talked about. And it's just a matter of getting over the fear of, even if you were to buy and it was still 5 o'clock and it dropped 5%, because it seldom does more than that, dropped 5%, and then it goes on to make 20%, are you going to be unhappy about that? Absolutely not. And check in with whoever you're getting your advice from, whether it's preferably Positive Real Estate and their coaching team, Steph, myself, and our fabulous teams, or whether you've got your own team. Just sense check it. Make sure that you've had critical thinking about what the opportunity is. You're not getting emotional about it, and then coach yourself to step forward and proceed. But the biggest regret I see is when I interview clients and they say, oh my God, like, if only I'd done more earlier. And it's really easy with hindsight to go, shit, imagine if I bought after the GFC and I just went nuts and I bought 10 properties, provided you could. Right? And in Brisbane, like, so many people got in early in Brisbane and then it didn't kick off when they thought it was going to. And they suffered sometimes 5 years or more of a flat market, because no one controls when a market goes. And then the ones that were brave enough and held suddenly had the most crazy growth. I was talking to a client last night. She bought a high-end apartment for 1.6 million and she got it valued. She's had it 5 years, I think, in total. She got it revalued the other day for 3 million. And it's insane.
3 times quicker than the Australian average. That is amazing.
Yeah. And it just goes to show the right market does get capital growth. That's a story for another day.
We should have done it. We could do a session on that.
We could wax lyrical, but I know you've got other stuff you need to get to. And I've managed to twist Steph's arm to talk to us today because she had some really good on-the-ground insight. She's been hanging out very closely with Sam. She brings, like I said, all her experience from CBRE, Colliers, and a long time in the market. Awesome to have you today. Thank you so much. Is there anything else that I haven't asked you or touched on?
Do you know, if we're talking about sentiment, I think the last thing I will say is once you start to read about it, it's too late. And and I think that's the thing, is that the Melbourne market at the moment is missing belief and sentiment. Once the media is always the last to jump on the bandwagon. So once you start reading about it, you've missed the boat, unfortunately. So it's still pretty bleak out there media wise. So it's still a great time to jump on.
I love it. Thank you so much, Steph. That's it for us today, folks. Bye for now.
Thank you.
Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.